Good day, viewers. Welcome to another episode of Financial Accounting Made Simple. Today, we will be looking at the purchase return label. The purchase return label is also known as the return outward journal. As you all know, that when goods are purchased from supplier, there are cases whereby goods that are delivered by the supplier may be a wrong description as a result of defectiveness, damages, wrong kinds, and these goods are returned back to the supplier. In this case, how do we treat this type of situation when we have a question that has to do with purchase return outward journal? We are going to be looking at the question that has to do with Yemi Cardoso, in as much as we make some purchases under the reporting of Yemi Cardoso. We are going to be making some returns from Yemi Cardoso to the suppliers. So in this case, we have to write up the return outward journal of Yemi Cardoso for the year ended 31st August 2002 and post to the ledger. August 15, return to Coca-Cola Limited 6 crates of Coke at 240 naira each. 1 crate of Fanta at 120 naira each. Trade discount of 20% was given. August 20, return to BZ Limited 14 bags of flour at 10 naira each, 40 soaps at 2 naira each. Trade discount at 10 cents. One thing we need to understand is this: irrespective of trade discount that is being given, in as much as trade discount is given when we are purchasing, also when we are returning, we are going to charge the discount that has been given in the first instance. Mind you, under some certain condition in examination, they will ask you to prepare the return inward or return outward journal without giving you the trade discount. As a student, an intelligent one for that, you need to know that the trade discount that was given at the first instance when you purchase the goods or when they sell the goods are the same trade discount that will be used to charge your discount when you are returning back to the buyer or to the supplier. Now, we have already prepared our journal. We are going to start inputting all our details in the journal. August 15, that's the date of the transaction. August 15, year 2002. 6 crates of Cokes were returned at the rate of 240 naira each. 6 crates of Coke at the rate of 140 naira each. If you multiply 6 at the rate of 240 naira. 240 naira. If you multiply 6 at the rate of 240 naira, we have 1,440. 1,440. 1 crate of Fanta at the rate of 120 naira each on the same day. 1 crate of Fanta at the rate of 120 naira each. This gives us 120 naira. When we add up, we have 1,560 naira. Mind you, when we are buying from Coca-Cola at the first instance, these goods were charged at 20% discount. So when we are returning as well, we return back at 20% discounts. So less discounts at 20% of 1,560. So 20% of 1,560 will give us 312 naira. 312 naira. So when you borrow one from year to year to half term, you have 10 minus 2 will give you 8. You have 5 left here minus 1. You have 4. 5 minus 3, you have 2. And 1 minus 0, you have 0. Now we move to the next question, which is August 20. August 20. August 20, some goods are returned back to PZ Limited. And the 14 bags of flour were returned at 10 naira each. So we have 14 bags of flour at 10 naira each. At 10 naira each. This gave us 140 naira. Also, 40 soaps at 2 naira each. And this gives us 18 naira. When we add up, we have 220 naira. So we have to charge 10% discounts. 10% discount from this. And charging 10% discounts, we are going to have less discounts at 10% of 220 naira, which will give us 22 naira. So taking out this, you have 8. 11 minus 2, you have 9. And you have 2. So this figure, I'm bringing it out here, 298, which is the amount that we have left after taking off our discount. So we sum up the totals from Coca-Cola and from PZ to know the amount that will be transferred to our return outward journal. So taking out our discount from the total amount that we got here of 220, we have 198 naira. So we go to the total column and add up the total from Coca-Cola and PZ to know the amount that will be transferred to our return outward accounts. So adding up, we have 1248 plus 198. This gives us 1466. So we have the total of 1466 that we transfer to return outward account. Transfer to return outward account. So once we are done with this, we prepare our ledgers. We have how many accounts here? We have the Coca-Cola account, the PZ Limited account, and the return outward account itself. So we have already prepared 3 ledgers. So from these 3 ledgers, we are going to have Coca-Cola account. We are going to have PZ Limited account. And we are going to have our return outward account. So let me go back my nearest side here. Now, the accounting procedure imposing to the return outward account is different from the purchase journal or purchase account. When we are posting to the purchase account, we debited the purchase account and credited the individual supplier's account. But in this case, since we are making returns to the supplier, we are going to debit the supplier's account and credit the return outward account. So here we have August 15. The total we had there is 1,240. So we have returned outward 1,248. Others 20 for PZ Limited, return outward 198. At the others 34, we have sundries. For sundries, we have a total of 1,466. So in doing this, we have completed the preparation of our journal and posting to the ledger account. If you enjoyed this video, kindly share, subscribe, and like on all our social media platforms. Thank you for watching, and watch out for the next episode.